Are there any Tower shareholders here already? Who's a shareholder? Not very many. Well, so that's a great opportunity then. Let me tell you a little bit about our company. I'll try to be as quick as I can, so there's plenty of time for questions. First of all, Tower, it's an AIM-listed oil and gas company, of course, focus on Africa. What I'm going to talk about mostly is Cameroon, because that's, I think, the most important project that we have at the moment, and it's the one that's closest to cash flow. And as David so rightly pointed out earlier on this evening, cash flow ultimately is what investment's all about. However, we do have some other interesting assets from our legacy as an exploration business on AIM for a while, notably in South Africa, and I will say a word or two about that at the end, and also Namibia, where we've been involved for over a decade. But mostly I'm going to talk about Cameroon because we are currently drilling what is for us the first well, but for this structure the third well, which aims to be a mix of appraisal and development. It's an intended producer, but the first of 4 producers that we want to drill on this well over the course, on this structure over the course of the next 12 months. And the aim of the well is to unlock 18 million barrels or so of contingent resources that have already been discovered on the structure. But we also hope in due course to test a further deeper reservoir with a further 18 million barrels, and there's quite a lot more further prospective resources on the license. So in total, we're targeting quite a large amount of resources on this license. And our aim is to get to production hopefully by 2020. The amount of money involved is significant. We ourselves have a market cap the order of $10 million, but the EMV10 of the contingent resources is over $100 million, with another 100 odd potentially in the prospective resources. So there's a massive upside, and one of the questions which I'll hope to address as we talk is why that upside exists, why we're not already worth $100 million. The Dali block in Cameroon, for people who are unfamiliar with Cameroon, Cameroon sits kind of at the corner of the Gulf of Guinea, between Nigeria on the one side and Equatorial Guinea over here. So it's in a very petroliferous area. The sheer volume of oil being produced from Nigeria totally dwarfs Cameroon, but even little Cameroon is not a tiny oil producer. The peak production in the 80s was over 180,000 barrels a day from Cameroon. Plenty of oil has been discovered there, though today the production is less than half that figure, mainly because the attention of the majors was drawn away from Cameroon towards Nigeria and Angola, where the sort of massive numbers could be found. And the local producers, mainly Perenco and Adax, have been focused more on big gas projects recently. However, there's quite a lot of oil and gas infrastructure still in Cameroon and substantially unused. As you can see here, Perenco and Adax have a sort of whole complex of fields, small fields, relatively shallow, but all still producing and producing healthy volumes, which mainly goes to this Masongo terminal, which is a joint venture floating terminal between SNH and Perenco, and that's where Cole and Lokele crudes are blended and sold. So the Thali block that we have is here pretty close to Dasoni, which is a Perenco-operated oil field. That's not a coincidence, because originally the block was called the Dasoni block. It was one of Total's assets in Cameroon. Total sold out of Cameroon a little less than 10 years ago because they felt it was too small. They wanted to concentrate on things like Nigeria and Angola. And at the time, they drilled a number of wells on this area. The Dasoni area in the north had 3 of those wells on it and was obviously a small field ready to put into production at the time Perenco bought the assets from Total. The license under the original deal with Total was also anyway the end of its exploration period. So Perenco took the thing over, immediately decided to develop this field, which is about 25 million barrels, and relinquished the rest of the license. Disoni North is now in production. I think peak production is around 12,000 barrels a day. It's a nice little earner. They've got an unmanned platform, former converted jackup that they used to put the thing into production. The initial flow rate on each of the wells was about 3,000 barrels a day. This is why it's very cheap to develop there. It's all in very shallow water. We're in about between 10 and 50 meters of water here. So we're offshore with all the benefits that brings in terms of making it easier to develop and easy to move and sell the oil, but without any of the high costs and technical challenges of the ultra-deep water. The interesting thing was that there's this structure at Njonji in the southern part of the license where Total also drilled 2 discovery wells before they left. But that was just sort of left open. No one was sure what to do with them. And there are some reasons for that, but that's why the license was available. And we were able to secure it in 2014, get the license agreed in 2015, and have been working on it since. Now, what was happening in the license, in this structure, when Total drilled the first well, they were quite excited to be a relative term, because for Total this is all just so small that they're sort of not particularly excited about anything. But they thought at the time that this could be one structure, but there were some faults that were visible on the old seismic, and this was 1990s vintage seismic, which made them a little cautious. So they drilled a second well just the other side of a fault that they could see, and they found indeed that the second well was the other side of a sealing fault, and that in turn meant that they were no longer so sure which of the other faults they could see on the seismic might seal different parts of the structure. That didn't necessarily mean the structure would be any smaller if all the compartments were oil-bearing, but it did still mean that at minimum it would be more complicated than simply having one big structure to figure out how to drain. What we did, we reprocessed not just the one survey directly over the license that had been available at the time, but we took 5 different 3D data sets from not just across the license itself, but also quite a lot of the surrounding area, so that we could tie into well control from wells outside of Disoni and Dali, as well as inside, to get the best possible reinterpretation, reprocessing and reinterpretation of the seismic data. We applied all the modern software, so we got far better resolution and interpolation. And we got a much clearer picture of what was going on. And what we found was that the thing looked quite different from what Total had originally thought when they were evaluating it in 2010 or so. We found that, in fact, although this fault did seal, there's another fault across here which only sealed at the lower reservoirs. There's 3 stacked reservoirs here, and maybe more, but 3 that we've identified so far. And the upper reservoir is not sealed. So therefore, we could see quite a lot of this structure in the upper 2 upper reservoirs, which meant that there was a good 18 million barrels of contingent resources. That's P mean. Could be more, could be less, but that's the best estimate we've got. All of which connected to the 2 existing discovery wells. The lower reservoir, which is fairly thin in the north but much deeper in the south, is sealed from those wells by this fault. So therefore, the lower zone, which may well be oil-bearing as well, would add another 18 million barrels or so of additional prospective resources in the same structure if it's oil-bearing. But the only way we're going to find that out is with the drill bit. So there's an existing sort of appraisal and development aspect to this structure based on the 18 million barrels or so that we know is there. But also there's a relatively low-cost exploration upside on the deeper reservoir. In addition, though, I should say that this is an exploration license in which, even though we're already at the end of the first phase, the first phase was 3 years, we now extended it to 4, we have 2 exploration renewal periods ahead of us on the license. So we can continue exploring here for up to 4 more years and drill more exploration wells at the same time as getting temporary production authorization to do an early production and long extended well test on this structure. Because the other thing we saw on the reprocessed seismic, much more clearly than on the old seismic, there's substantial opportunities up in the north of the license. We were originally thinking we might just find a direct kind of extension or analog of the Dasoni North field. What we found was different from that. It's not the same reservoirs, and therefore it's riskier than just looking for an extension of Dasoni North, but bigger. And the scale of these things is of the order of magnitude. You can see 30, 35 million barrels recoverable in multiple fault blocks. Now, the chances of any one of those fault blocks having oil in it is still typical exploration type percentages. More likely than not, they won't succeed. But the chances that none of them have any oil in is, in my view, rather lower. I mean, you know, the likelihood is that there's something there. And the great thing is that if you're in the exploration phase of a license, but you also have a temporary production authorization, so you're building a cost recovery pool, well, the exploration wells that you drill on the license, they form part of the cost recovery pool for your production. So even though we'd have to finance in the short term out of cash flow the exploration wells to see what's going on up here, the money comes back in a matter of months once you're in production. And so therefore, at very low risk, virtually no risk to shareholders, we can also explore this upside. So what we have here is an interesting project where there's an appraisal and development for what should be a healthy cash flow generator, hopefully from 2020, in the Njonji structure, but with a lot of very low risk upside, both in the Njonji structure itself and in the area to the north. So how are we going to make that happen? Well, the first step is to drill a third well, and our plan is to drill that well here in the still north of this potential sort of partial fault, but a straightforward vertical well in order to test the reservoirs, both the shallower and deeper of the reservoirs. And by the way, all of these are pretty shallow. I mean, we're talking about 1,100 meters or something. The reason we want to do this is because when Total drilled these wells, they tested them while drilling, so we know that there's 35-degree API oil, low sulfur, very typical for the region, but they didn't do a flow test to surface. So we don't have a good sense of what the potential initial flow rates could be from the wells and how they'll perform. Ultimately, the only way to find out is to get them into production, which is one of the rationales for doing the extended well test on the Njonji while we also continue exploring elsewhere in the block. So that's one of the reasons why we can do what we plan to do, but also it's important simply to plan that extended well test that we start off with a better sense of what the initial flow rates are going to be. To give you an idea, in the Rio del Rey it's not unusual to have anywhere from 1,500 barrels a day up to 3,000 barrels a day from stacked reservoirs like these. But as I mentioned at Disoni, although they had 3,000 barrels a day up there, different reservoirs. So we have to do the test. Once we've done that, we then plan to move forward to drill at least 3 more wells from the same location and bring a mobile oil production unit to the location in order to facilitate that. The amount of wells required to kind of drain this area will depend on what we find with that first well. But we're assuming we're going to need at least 4 and possibly more. But the NPV of each well is very attractive. Each well, we expect, if it flows around 2,000 barrels a day, it'll probably require drain about 3.5, 4 million barrels per well. But if the flow rate's higher, and we'll see how the reservoirs perform, we could get more. On the other hand, if there's more oil there, we may need more. So this first well is very important for defining the parameters of the extended well test and the initial production project. But even though it's very important, the geological risk on it is extremely low. It's a question of identifying the parameters, not whether the oil's there. One of the wells that we'll drill away from this location, though, will go into the South Fault block. We'll do that because we definitely want to drain the oil from the upper reservoirs in the southern part of the structure. But in addition to doing that, we'll also test that deeper reservoir. So when we drill this first well, we expect to immediately move the 18 million barrels plus or minus of contingent resources into proven reserves. When we drill the other 3 wells, which will be the initial producers from the northern zone and from the upper reservoirs in the south, if we find oil in the deeper reservoir here, that'll immediately, order of magnitude, double the reserves, and those will go straight from prospective resources into reserves because they'll be connected up to this central location. So that's what we're doing. Now, the potential value associated with this is large. If you look at the best estimate numbers, which are sort of like the P2s, the best estimate NPV of the P2 is $139 million, according to for the contingent resources, which is pretty good going when you bear in mind that that's net of the cost of doing it. And Tim Lyons at Oilfield International estimates the cost of that at around $80 million. Could be that, could be a little less. I'll talk about that in a second. But what that means is that once that development is funded, what you've got is going to be worth well over $200 million. So there's a lot of value in there. He's got a low number on phase 2 in his best estimate case. That's because in his best estimate case, we only need 1 more well. So that's just the NPV of 1 more well in their variant of the thing. If there's more oil either in the northern part of the structure or in the southern part, you're looking at as much NPV again. So there's a lot of potential NPV. There's a lot of potential value to aim at, and I was interested listening to what Sachin was saying earlier about the key value inflection point coming at that point where you're approaching cash flow, but you're not yet there. And I like to think that's sort of where we are. Why are we trading for a market cap of $10 million or less when the NPVs are this high? The reason is, I think, really because of this. It's the fact that to get to that NPV is based on an assumption of a 10% cost of capital. And the question which investors, I think, are asking themselves is, well, can they raise that capital? Can they do that? And again, this interestingly reflects some of the themes that Sachin was talking about the issues with the issues with raising money when you're at this delicate pre-cash flow moment. So a lot of people look at this, and I'm not going to hide it, it's the elephant in the room, so I want to look right at it and say, well, hang on a minute, there's nearly $80 million there, how are you going to fund that? Now, the answer is that a lot of money can be raised once you've got your proven reserves. And some money can be raised on contingent resources as well. And one of the things that one's got to remember is that there's a bit of a spectrum of risk here. Of course, you can't raise debt financing for pure exploration. But on the other hand, you certainly can raise any amount of money you want against a producing reserve. And at the point where you've got the proven reserves and a clear plan to production, well, then you can definitely raise debt. I'm delighted that Coro were here talking about their Eurobond issue, because the number of people who say to me, oh, you can't possibly raise debt against something like this, too early stage and so forth. It's true. Most people can't do it, and most assets can't justify it. But that doesn't mean that no asset can justify debt financing prior to production, and that doesn't mean that nobody can do it. And in fact, when I look back at my career, a lot of it's been about creative financing solutions. So we're working on debt financing right now for this project. Now, what will be the terms of that debt financing? I don't know. How much equity will be required to go with it? I don't know. But what I do know is this, that first of all, it's possible, otherwise I wouldn't be standing here talking about it. And secondly, the fact is that you don't need to, there's an old saying, how do you eat a cow or whatever, one steak at a time. You don't try to eat the whole cow. So similarly with the financing for a project like this, we don't need to raise all this money at once. What I do want to do, though, is before I raise any more money for this, I want to have a clearer picture of what our debt financing can look like. Because our debt financing, if it's the right structure, could mean we need no equity at all, which I'd like very much and I think is still possible. It could mean that we need some more equity, but the amounts will be clearly defined and the amount of debt that the equity will bring will be clearly defined. And that's a completely different fundraising case. So that's why I think, first of all, we're valued at the moment as if we have a huge risk, but it's not a geological risk, it's an execution risk. It's a question of whether we know what we're doing and whether we're capable of actually getting this done and financed, which I firmly believe we can. And secondly, the upside is commensurately enormous. I think that's all I want to say about Cameroon. I'm going to speak very briefly about South Africa and Namibia because they're less important parts of our portfolio. But I want to say a few words about South Africa because of the Brulpadda well that was drilled by Total, and the result for that was announced just last Thursday. The block that we have is a joint venture with New Age. It's operated by New Age. Some of you, those oil and gas investors, will be familiar with New Age, even though they're not publicly listed. New Age we know well because they're also operating the Atinde gas block in Cameroon. But here in South Africa, we farmed into this Algoa Gamtoos block when we acquired Rift Petroleum in 2014. And we did this specifically because we thought it'd be an interesting alternative thing to do at a time when we were drilling a very high-risk well in Namibia, which was operated by Repsol. And we thought, well, what are we going to do if, as is most likely, that well doesn't succeed, which it didn't. So we then farmed into this block, funded some of the second sort of set of 3D seismic that was done over the Algoa area. The Gamtoos area, there's three basins in here, Algoa, Gamtoos, and Outeniqua. And there's 2D over everything, though less over the deeper area. But we funded a bunch of 3D over Algoa, which brought to light quite an interesting target, the Canyon prospect, which is an 80 million barrel prospect. So nice, good sized thing. But the reason why we in New Age were focusing our attention on the shallower areas was because there's plenty of prospects, but also they'd be reasonably economic to develop. So at the time, the thinking was, well, if Utaniqua Basin, which is deeper, looks interesting, that'll be something that the majors will probably be most interested in partnering with us on. And they'll have their own ideas about exactly what they want to do in terms of developing that lead. But we should be figuring out how we go about dealing with the shallower stuff ourselves. But we do have 2D seismic over a very interesting deep Albion lead in the Utaniqua Basin. Now, around about here, in the next door block, about 150 kilometers away, Total have been drilling this Brulpada well, and they've been at it for years. They first tried to drill it back in 2016. They had a very high spec rig, couldn't deal with the currents, and they eventually had to abandon the well. They were so keen to drill the well that they brought a massive semi-sub down from the North Sea that could handle the currents, and set about drilling all over again a month or so ago. There have been a lot of people interested in this well precisely because Total put so much effort into it. So Africa Energy farmed in via the back door, Qatar Petroleum farmed in by the front door. It's been a long-awaited well result. We've certainly waiting since 2016 for it. So the result came in on Thursday, and it's very good. They've made a large discovery. It's a gas condensate discovery. They haven't told us yet, Total haven't said exactly what the liquid ratio is, but if it's a gas condensate discovery, it's reasonable to assume there's a fair amount of liquids there. But the great thing about this area is South Africa is a huge gas importer, as you probably know. So they're talking about, at the moment, initially they're thinking about a TCF of gas. And if that's right, although if that were offshore West Africa, that might be a little awkward to develop. It's kind of an uncomfortable volume where it's not quite necessarily big enough for floating LNG. Offshore South Africa would be very easy to develop, very easy to bring to shore. It'll take time, but that'll be a very valuable asset. Now, we've got this prospect here. The original operator estimate last year was that this was a 210 million barrel oil equivalent opportunity. Could be either wet gas or maybe oil. But they've now had so much interest, because we've been doing a farm out process for the last a couple of months. They've had so much interest in that Utaniqua prospect. They've done a lot more work on it and had a lot of dialogue with the people in the data room. There's been half a dozen companies looking at it. And as a result of that work, they've done some also reprocessing of the AVO and 2D seismic data, and they've upgraded that prospect to 364 million barrels, which is what we also were able to tell the market last week. So we've got a very interesting block in South Africa, nowhere near cash flow, but in terms of prospectivity, very interesting opportunity. In Namibia, this is even longer term, so I won't dwell on it, but we've been involved in Namibia for more than a decade now. We have very interesting blocks. The reason we picked these blocks was because the oil shows from the wells that were drilled way back in the last century, but they encountered oil in two zones. There's clearly working petroleum systems there in Namibia. The question is, where's the oil migrated to? In our block, we've got these fantastic giant structures in the deeper water. And I mean really giant. These are sort of multi-billion barrel prospects. But we already drilled one of them with Repsol's help, and that didn't work. People have been focusing more on the fan systems nearer the land. That was the idea behind Tullows Cormorant well, which was drilled here. And we have a whole bunch of prospects in here as well. So we've got a fresh petroleum agreement, which gives us 4 to 5 years, really, just for the first exploration phase. It's not going to cost a lot of money, but in terms of long-term potential, I do believe Namibia will become an oil province. And the nice thing is that having spent the money we spent a few years ago, mainly Repsol's money, but unfortunately some of ours too, having spent that money, it means we get to restart the whole cycle. And as a result, we'll get to watch the wells that are going to be drilled, and there are people like Exxon who are going to be drilling over the next 2 or 3 years, and learn from that and see what we can do in the future. Anyway, that's the story. We've got a nice team. We've got plenty of technical resources. People have been together for a long time. We know each other well. And it's important to stress that although we're a minnow, that doesn't mean that we compromise on the quality of what we do. We've got a long-term strategic arrangement with EPI, who provide us with the G&G backup, and they've got all the software and so forth that any much more substantial company would have. The wells we're drilling in Cameroon, we've got Bedrock Drilling, who drilled the last 2 wells in Atende, managing those wells and supervising them. So we're not compromising in any way on our technical capabilities, and we are looking for that first oil in Cameroon and hoping to have it very soon.
Thank you. There's a question at the back. Here we go.
This isn't a question, it's an answer to your question as to where the oil went in offshore Namibia. But when Cherry drilled there in 2012, they noticed anomalously high temperatures downhole. And they put that down to the fact, what they deduced was that the source rock matured early and the traps formed late and the hydrocarbons migrated off. And I don't agree that it will become a petroleum province. That's my view.
Well, I'm not sure if that's a question, but what was my question? Where did the oil go? Yeah, well, it's, you could be right. I mean, this certainly happened in some places. When we looked at the Welwitschia anticline, which was supergiant, Repsol drilled it, spent over 100 million on the well. One of the things that we'd noticed was that there are a lot of chimneys leading up from the Albion and up towards the Maastrichtian, and then they stopped flat at the point where the Maastrichtian was sealed. And at the time, we viewed that as being very encouraging, because we were thinking, okay, so obviously there's a large volume of something that's moved through here, and it stopped there. And that was where the AVO anomaly was, and so on and so on. I mean, it looked very good. There was nothing in the Maastrichtian. So whatever it was, either it wasn't the oil or gas, or it went somewhere else. Undoubtedly, and I am worried myself that that may be not just happening in that particular structure, but in some of the others. But that's why I think it's worth looking now at the fan plays nearer to the shore. That's where the oil shows were found in the wells that were drilled back in the sort of, back in the sort of 1980s sort of era. And you would expect something different to have happened there, that we know there's a lot of different source rocks. So whether one particular source rock is good or bad isn't dispositive for the whole area. And, you know, I think that obviously there's a lot of smart people, because I'm not a geologist myself, there's a lot of smart people who do think that there may be something there, from Exxon to Tullow to Africa Energy and so on. But where it is, that's the interesting question. And there's going to probably be more wells that need to be drilled before we get the clues.
Do we have any other questions at all? Well, on that note then, we will wrap things up. Thank you all for coming. Thank you, Jeremy.
Thanks.